Good evening, fam. The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's see, before I get deeply into football tomorrow, go Cowboys. I wanted to do really put a quick read on record of what's going on with the markets, what we should look for this week. This market is I'm kind of getting annoyed with myself saying, this week, pay attention because this market is moving so slow. It's like creeping at these very small amounts. So it's like it's obvious that there's some drag in it because the S&P won't spring forward and continue making a higher high, and the signs now are there of it rolling over. So that's what I want to discuss. Point you to some things to pay attention to tomorrow or this week, this coming week, because we've crossed one kind of line in the sand, and we're approaching another. So I want to keep you focused on that. What's up, Devin? What's going on? Let's see. Let me get my screen share. Get that happening. Let's see. So we're gonna run through tonight the S&P. We're going to break down, look at the all of the components very quickly. Hopefully it's not going to be too long of a video. And then we're going to look at the bond yield, which has implications for housing. So got a lot we're going to run through, but I'm going to make it really quick. This is not exactly anybody's idea of fun on a Saturday night, but it is important, and this is a good time to take it in before we get busy with the week. Okay, I want to repeat that this is a good time to be talking to a financial advisor. Talk to your plan administrator for your retirement account. Go to your credit union or bank. They should have some free information there for you. This is the time to sit down and talk to someone. Okay. No matter how much you think you know, if there's free information out there, sit down and have the conversation. You can take some of the stuff that I'm saying and put it in the form of questions. Run it by the person giving you the information. I will strongly suggest that make sure that the person you talk to, in addition to fundamental analysis, that they also know technical analysis. Keep looking until you find someone that knows technical analysis as well as fundamental analysis, because the fundamental analysis, the problem with that school of thought, in my view, is they're likely to tell you to stay in the market and diversify and don't worry about it because you're diversified. Well, all of that diversification, really all it means is that you're not going to lose everything. Okay, you'll lose less, but we're not trying to lose less. We're trying to win, and you can win. And if they are not an adherent of technical analysis, they will say things like, "You can't time the market." Sure, you can. That's what technical analysis is all about: timing the market. Okay, can we time it exactly to the penny? No, we can estimate it. We can get you close. You don't. We have the tools tools to get you out of a long downtrend that would destroy your assets. So yeah, technical analysis works. So you want to make sure that the person you're talking to, in addition to fundamental analysis, that they also are competent in technical analysis. You know, just ask them, do they practice, technical analysis? Are they, certified in that, or, if they use that information, technical information, that, they don't necessarily have to be certified in it, but if they, at least if they know it and they have some level of respect for that discipline. So there's that. What we got here is the S&P 500. I'm going to go back just to show you the bigger view, and then we're going to speed back up to where we just were. Let's see. This is the trend from 2009. This is the money you're trying to keep. All this money right here you're trying to keep. And this particular downturn, if I'm right by my Elliott wave theory count, we're talking about destroying all of this. All of it. Not some of it, all of it. All of it. All of it in less than 3 years, 2 to 3 years, about. And these are based on duration of past declines, and of course, it doesn't. How they say, past performance is not a not a indicator of future performance. Okay, got that out the way. But if it stays true to past form, we're talking about maybe 2, maybe 3 years at the outside. So this could be over really fast. And the problem is, if you're not watching it, markets fall faster than they rise. So if you're just using your instinct and thinking that, hey, things have been good for the last 10 years, hey, I can afford to get around to it later in terms of checking on moving my money, or sitting down with a financial advisor. The problem with that thinking is that in a month you can lose over a year of this gain, because prices fall faster than they rise. As the saying goes, prices take the escalator up and the elevator down. So you don't want to go by instinct on this, okay? Now, because it took a long time to rise does not mean it'll take a long time to fall. All right. Now that said, let's see. I'll move on. We got I'm at the daily chart view, and what concerns me. Make a long story short, this area we are here is a Fibonacci extension area, where it was a known area of resistance. This was known back in crap. This tells you this is a big wave. I have to keep going to the weekly chart. This wave is so long. It was known when we broke above this prior resistance right here back in April of 2013. Okay, so we kind of knew way back then that this particular area, by this horizontal line at the top, is kind of marking that area, that this would be an area of resistance. So we kind of knew that. It's a theoretical top, and we seem to be the theory is proven to be true in this sense. And what's troubling is we had a high, and hold on, let me back out. This thing could have died here, and in fact even here. So it caused suspicion here. Okay, so it fell, and then it moved slightly. This is like nothing to move from 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 this high to this high, and then we really thought this was over in October of 2018 to this past Christmas. Okay, so what was happening? I think all of us technicians, we knew that we were in this trouble area, and the slightest little bit of panic, a little trouble, we were freaking out. So the market took this severe dive. Now the suspicious thing is that given that we made a higher high here relative to this high, the price is just not wanting to really break out above it. Usually when you make a higher high, you go a good bit more, especially when you have a steep decline like this. That's not happening. Okay. So the price ran out of gas right here. And this is the troubling part. I'm giving you guys a really crude shorthand of stuff I talk about on my Patreon over a longer stretch of time, being more detailed than this. So I'm just gonna compress it for you guys. So we made this high in July of this year, okay, and we were over bought on the oscillator. We sold off. We came back up, but we didn't make a higher high. Instead, we broke this trend line. That's a problem. That's a concern. Okay. Also, when I'm looking at this particular peak right here, and the information box says 29.43.31. So we had a horizontal channel here. I'm ignore this part, everything after this for the moment. We had a channel right here, and the price popped up right here, broke above the channel. Let me get a okay. So we were trading sideways here. And then on September the 5th, we had a breakout, which is a good bullish indicator, a good sign that, hey, we're going higher. And the bull camp, of course, would think that, we're going to take out this high like the other false signals that I talked about earlier. Well, instead, it turned and made a lower low. Okay. The rule of trend is as long as the price keeps going higher and the lows keep getting higher and the highs keep getting higher, then that's an uptrend. Well, when it says, uh-oh, and it starts making lower lows, of course, that's a downtrend. And the price came right back here. This is Friday. This red candlestick here is Friday. It fell right back to this support or this former resistance, and it's now support, but the momentum is turning down. So this week is going to be critical to see if the S&P stays above this floor. If it goes below this floor, then there's no reason why it can't continue to fall. Okay. The normal sequence of things is the price falls to the floor, prior ceiling, current floor, and goes higher. So that's what we're looking for this week. Are we going to go higher than this candlestick right here, or lower? Once we go lower, that's going to send pessimism to especially all of the technical traders. Okay. And this thing could pick up speed because of that pessimism. So let me see. There's one other line I would want to put here. This support. So we're going to be looking to see if this support maintains. But again, the fact that we didn't make a higher high, that's casting some suspicion and doubt on this trend, as well as the fact that the momentum is already rolled over. Okay. So that doesn't look good. Well, we'll see. So that's what we're watching this week. Do we break below this floor and break this trend line. And this is a trend line that's been running since Christmas, which saved us from what we thought was the decline then. But, you know, this could be it. We'll see. We'll see what it is. All right. What else we got? What I have here is a chart of the entire run of the S&P from March of 2009 to this past Friday. Okay, and we can see all the things that made money. Discretionary, that's clothes, that's your retail stores and your cars. And discretionary basically means stuff you don't need. Okay, basically, it's not stuff you need for survival. Okay, trinkets and crap. Okay, stuff we like. Okay, fun stuff. All right, consumer services. Um, you know what? I'm not sure what this is. Is this like AT&T and your cell phone, and it might be things like that. I could look into it. I mean, dig into it, but you get the point. Consumers in big infrastructure, consumer. I'm sorry, not consumer. Communication. I'm saying consumer. It's communication services. And I'm thinking that that's like your cell phone providers and things like that. Uh, Technology, duh, we know what that is. You know, NASDAQ, Apple, and all that stuff. Google and all that stuff. Industrials, those are in big industries. Materials, of course, metals and things you need to build infrastructure. Energy, basic, obvious, oil, gas, coal. Staples, boring stuff like groceries. But oddly enough, this is where we're going to be talking more about this later, because this is where we need to be right now. One of the places, this right here. That's why you see that fake meat thing, Beyond Beef. That's not a coincidence why that particular thing is rising. It's because that entire sector, the staples, which is food. Food is a staple, right? Okay, so that section is going to be a place to really study for some opportunities. You got to pick and choose, but that's going to be a lot of wealth there, a lot of wealth of opportunity, because money is going to rotate from these places that did well to some of these places that didn't. Energy, I think this is going to keep falling because the dollar has a lot more to go, and it's going to just kill this. This is just going to get destroyed. Energy is going to be the new penny stocks, right along with these materials. This is where your gold and your copper and silver. I know people think gold is safe. Well, they're going to learn it's not. And gold and energy, they're going to be the new crypto. They're going to be so cheap that this is going to be like cryptocurrency. You're going to have like buying gold and ocean shippers for pennies. Okay, that's if they don't go out, or the ones that don't go out of business, because there's going to be a lot of that. There's also in this slowdown in the economy, I've mentioned this on the Brain Trust. When the economy slows down, you get a lot of mergers. I said this a year ago to tell, look out for a lot of mergers. And what do you see on the news? Everybody's trying to merge because these corporations, they know the pie is going to get smaller. The market, everybody's sales are going to be reduced. So why risk your company going under and you're not making any money? So they make a deal. So one company buys another, and that company that's buying the other one, they get a larger market share. Now they're going to suffer as the decline comes, but when it's over, they're going to have more customers because they're buying all the customers and the best management and best staff from all the people that they're acquiring. And the selling companies, they get cash. So it works out for everybody. One side wins now because they get the market share, or later they win later because they're acquiring really the market share and human capital and other resources in these hard assets and patents, and they're acquiring all of that in these mergers. And the other side, they get cash, so they can take the money, go and invest it in these staples, make a bunch of money, and when the decline is over, they come back in and then they start buying up stuff. So that's the dance. Healthcare, this one I'm not so sure about. Drugs, maybe. Some of those drugs should do well, but I'm not sure about the healthcare providers, because as the layoffs come, people not going to be able to pay those premiums. And so if you can't pay the premium, how the hospital going to make money? So I'm not sure about that one. This one, it's going to require more research to pick over the bones to find some good stuff. But the rich area where you'll find more is right here in the staples. Then we got utilities. Oh, now this is my favorite of them all. But you got to kind of pick over this too, because you have to find the companies that provide you your electricity. Okay, because the utility companies purchase energy. They purchase coal and natural gas and oil. They purchase those things in order to provide you with your electricity. So when the materials that they use to generate the electricity is cheap, these utilities make more profit because these items are cheap. So that's a hot spot. But you gotta really look, take some effort to do the research to find the right company that has what they call a pure play. They're not trying to be in all these different business activities. They just do one thing. They generate electricity, power, and sell it to you. That's it. You know. Then you got financials. No, this is going to be this is going to get hurt too, because if people aren't making, if the economy isn't growing, then people aren't taking out loans, and if they aren't taking out loans, then banks don't make any money. Okay, even the trading firms are going to suffer, because people are not going to be the trading volume is going to go down. People are going to be leaving the market, but they're not going to be moving from asset to asset because they're not going to know what to do. So I think commissions are going to be hurt, even among, say, the brokers, and of course banks are going to suffer. Of course, I'll get to this. I'm just going to talk about the insurance companies, especially the mortgage insurers. They really going to feel it. Now, this has been the big winner since 2009. Real estate. Real estate. Now, this is where it gets sticky with that bond yield and the interest rate. That interest rate starts to rise, which I think it is. Nobody's talking about it right now. I'm like the lone idiot that thinks that the interest rate's going to rise. But watch. Remember, you heard Dollar say it first. Because global demand for the dollar is going to cause that interest rate to rise, and that's going to destroy housing, because it's going to be harder to get loans. And so that's going to hurt the mortgage insurers. Okay, so if people aren't buying homes, you're not making money selling insurance. All right, and we're at the top. How much higher is this thing going to go when the layoffs come? And they will come. Who's going to be buying a house? who's going to be able to pay their mortgage? So the foreclosure rate's going to spike. Okay, so this is going to be the last one. Now, I'm using as my, let's say, I guess, what's the word for it? For lack of a better word, my signal that I'm following for these markets is this one, because this is the king. This is the leader. You know, it's real estate, and the biggest real estate company is D.R. Horton. It's a home builder. And what concerns me here is this technical thing here we have called a double top. We were corresponding with this peak here. We were overbought. We went down oversold. We came back up to overbought. We returned to the same area, but not exactly. Let's look here. The high here says 53.32. And this is back in January of 2018. And now we have, this is a monthly chart. So this, the high of this month is 53.04. So we have not made a higher high, but I'm gonna go down to the daily so we can kind of see. Okay. Now you look how neatly this is going up like a staircase. And then you got this one. Doesn't look so good. Okay. Not to mention we have what we call a bearish engulfing candlestick. Okay. Fact that if you look, all these candlesticks make a higher high. Each one of them is higher. Each candlestick is higher than the previous one, except for this one. And this one that made a low also made the high. So it engulfs the moves of the previous candlestick, but it closed lower than the open. So that made it a bearish engulfing candlestick. So we got a signal, this big signal here on the 26th. That was Thursday. And that was interesting also because in pessimistic markets, Friday is usually a negative because people don't want to hold their money in the market over the weekend if they're pessimistic. If they're optimistic, greed makes them leave their money in the market on Friday because they expect it to open higher on Monday. In fearful markets, that's when as they approach Friday, they fear the weekend. They fear they're going to lose money over the weekend. And so it closed down on Friday. And so we'll see what happens here. But we got this, the stochastic showing us a little bit of negative momentum here. So this week, we'll see if it starts to die. And that would be pretty suspicious, you know, for the price to die without making a higher high. You're talking about a year and 9 months between peaks. Okay. All right. There is some precedent for downturns, or at least a big downtrend lasting, say, equaling to the duration of time that the price moves sideways. Okay, so if we went, so what's 9 plus 12? What's that? 21. So if it took us essentially 21 months of going sideways, that precedent, that pattern suggests we could be looking at 21 ugly months of going down. Okay, which is what I said earlier, way back in the top of this video, that, you know, usually, you know, in the past, most of these downturns have been like about 2 years. You know, I don't think we've had any. I don't even think the great, quote unquote, Great Depression was 3 years. You know, so that's interesting too. But this is the leading home builder. D.R. Horton is the largest home builder by market cap, meaning what that means is there's more money invested in D.R. Horton than any other home builder. So if the leading company is losing momentum, then that doesn't speak well for the rest of the stocks in that same industry that are not as strong as this one. So when the king dies, you know, that doesn't say too, say too much for everybody else. So, and then we have here what has my concern. Let's see. It's kind of like thinly traded. It's not like a lot of data. So you got this shadow of the price back here. But what we're looking at here is the 10-year yield. Okay. So what the yield is, the money you make off of, let's see, when you own a bond, okay, you got two things. When you buy a bond, you get a payment at the end at maturity. Now, during the life of you, during your the life of you holding the bond, you get interest payments. Okay, so the yield is the interest payments. All right. So you got the face value of the bond and you got the interest payments, and they kind of move inverse to one another. All right. So when these yields start to rise, that is a bad sign for the let's say the face value of the bond. All right. So that when they talk about the bond bubble, there's and that's trading older bonds. So what happens is as the interest rate actually has been dropping since like the early 1980s. So there's nothing for the interest rate to be dropping. It's been dropping for decades. Okay, that's normal. Um, but we hit a bottom. All right, been going sideways since like 2012, and the dollar has been rising since like 2011. Those kind of things kind of closely correlated. So the okay, the interest rate has been falling. So when the interest rate is falling, every whenever the government issues new bonds, and if the interest rate is lower, not if, since it's been lower, whenever they issue an interest rate, a bond with a lower interest rate, which is a lower payment that you receive for holding it, the bonds already in circulation, the ones that were issued previously with a higher interest rate, those bonds become more valuable because they pay more. So the newer bonds that come out paying less make the older bonds already in circulation pay more on a relative basis compared to the new. That's your bond bubble. Okay, and so the face value of those older bonds in circulation they get bidded up, So that's your bond bubble. I'm trying to make this this is a complicated thing I'm trying to make simple. But the fact that this interest rate has been going sideways within this range, or this yield, let me say that way. The yield has been going sideways for a while, and it's threatening to break this resistance, this downturn that started in the fall of last year before Thanksgiving, which corresponds to that rise in the stock market. So if this reverses, that's also setting the stage for the bond bubble to reverse, which I just showed you that the danger, or the suspicious behavior of the S&P 500, and I showed you the double top in the DR Horton housing um, stock. Now, what's going on? We're going to dig a little. What we have here on this page is a makings of a upside down head and shoulders. The red line represents there's one of the lows is here. It's set to here, like the lowest low. This red line is set to the lowest point here in 2012. You can't hardly see it because they don't have all the data, but that's the deal. And then we hit the ultimate low in 2016 in July, and then we came down here last month, and we made a low that was higher than the low in 2012. So we have a reverse head and shoulder. So this would be the head. Imagine someone standing upside down on their head. This would be the head. This would be the left shoulder. This would be the right shoulder. Now we haven't, it's not really official really until A, we got to break this trend line. B, we got to make a new high above this point, above the November point of this past November. So you go, Dollar, I don't see anything here. Well, that's why you got to go down other time frames. Now, this is where I'm going to go all the way down to 1 hour. And this is the move from, let's see. Okay, this is it. Right. Okay, this is that big resistance line. And we had a nice run up from September 3rd right to the resistance line, and then it died. Okay. But I don't think it's going to keep dying. I think it's going to rise. Let me see what this retrace is. Okay. We have a retrace right to a Fibonacci number. It's a 62% retrace. That's meaningful. The people on my Patreon, they know that. They should be tired of me pointing that out all the time. So it's pretty suspicious that we dropped here and started rising the 24th. That was last week. Okay. So we broke above the trend line, and it looks like here now I'm here. Now it looks like here we just broke it again on Friday right here. You can't that little horizontal thing right there to make it's a doji candlestick actually on I can't define all that. You got to join my Patreon if I can't get all into those details, but basically it's a candlestick signal of a reversal, or like I would say, I'm not going to say reversal. I'm going to say the bulls and bears have reached an equilibrium. The optimistic buyers and the pessimistic buyers have reached an equilibrium. It's like a tie. It ended kind of in a tie, and that and it closed right at the high of the previous candlestick. So it's really nowhere for this price to go but up and it's already broken the trend line. And remember, like I said before, when you start making higher highs, then that is a sign of a reversal. So we'll see this week if we go from here to take this out and continue going higher. So if you hear them talking about the rise in the bond yield on the news, then you'll know that this thing kept going. And I'll do a chart later in the week to talk about it. But this is going to scare the hell out of the market, because it's going to signal that this dreaded bond bubble that everybody's been fearing, that it's about to burst. Now they really this line is the real deal. This is minor. This is like the first suggestion that I'm not going to say first, this upside down pattern, upside down head and shoulders was a signal. Okay. breaking this trend line as a signal. So the next one is everyone's going to be on guard to see if we break this. And so let's see, this high here was, like I said earlier this month, it was September the 13th. We're talking, what, 2 weeks ago. Okay, so if we start moving higher and break this trend line, then it's on. Let me go back to the daily. Yeah, we come back up here and break through this trend line, then it's on. I wish I could make this more interesting. I can't, you know. I'm not no bond expert. I just watch correlations between things that move the markets, and I talk about those correlations on my Patreon. If you want to get deeper into this, you know, I also talk about not just this boring stuff like bonds, but some forex stuff. I talk about gold. Every once in a while, I throw up a Bitcoin chart, because the technical analysis applies to all of it. It doesn't really matter what you trade. It doesn't matter if you're a day trader, if you're a long-term investor, or right in between those two is what we call a swing trader, which is what I am. Technical analysis can help you in all of that. You could trade futures, forex, stocks, ETFs, mutual funds, you name it. The rules of how to read a chart, or options even. So the rules of how to read a chart apply to all of it. So if you want to get down with that, join me on my Patreon. Let me stop the share and see what we got. Who y'all ride with me tonight? I'm kind of fading as y'all can hear it, but I'm glad y'all ride with me. So we got Devin, we got Raining Woman. What's happening, lady? Oh, so if you're anyone was doing a stream, well, I'm gonna get off and I'm gonna come over and I'm gonna lurk in your chat. Okay. Kid Fall One. I've never seen that name. Welcome, welcome, welcome. CR Frank, what's happening? What's happening? CJH, what's happening? What's happening? My Patreon crew. Got some Patreon crew here, So yeah, y'all, I just did that video. I did that video over y'all tonight. I did the whole 20-minute video and didn't even press the daggone screen share. I'm like, you idiot. I got to watch. I'm like, man, ain't no charts coming up. I'm just blabbing, So I'm about to sign off unless anybody got any questions in particular about what you are concerned about in the news. I think you should be concerned about these markets. Don't get distracted by all this Trump talk. Okay, it's really nothing out there going on that's more important than you watching your money. Okay, there's nothing more important than that right now, because we're right on the verge of these markets picking up steam and going down. And the longer that, I'm trying not to sound paranoid or what's the word, conspiratorial, but it's a little bit of this true, y'all. The sharks, the uber rich, it takes them a long time to move their money because they have so much of it. They can't go into the markets and sell everything in one day because they have more money than the money that's being traded every day. So all these distractions, putting all this useless stuff out there in the media to keep our mind preoccupied, they are moving their money. Whereas you and I, we don't really have that much, but the little bit we have, it's our everything. We can move our money in seconds. It takes them weeks to move theirs. So they need us to be distracted so that they can get their money out. And then the whole house will fall down. And at the end of the day, the poor stay poor and the rich stay rich. But if we can take control of our mind and our attention span and concentrate on what's most important at this key moment in time, we can participate in the greatest wealth transfer ever. We can take their money. We can get the money back that they've been taking from us. Okay. Because we have so little money, we can move quickly. But we're going to need to apply the skill of reading the charts, because wherever it is they're trying to go with their money, we can beat them there because we have less and we can trade everything in seconds and get to where we want to be. They have to buy in a little bit at a time, because when they start to buy their purchases, make the volume indicator spike. And when the volume indicator spikes, that gets the attention of all those trading bots and makes everybody else starts buying. And then that makes the price go up before they can get in. So they have to buy in a little bit at a time. And so they have to keep us distracted with BS while they do that. So that's my story on that. I'm a bailout fan. I'm gonna try to do more. I'm gonna try to get into some more interesting stuff. I appreciate y'all hanging in here with this bond talk. Bonds are incredibly boring, you know, but they're important. They're important to understand. But we're gonna talk about some other stuff later. I'm gonna try to keep it positive, because there is always someone is making money all the time. Nothing. When the market declines, when we say things like the market is down, well, everything isn't down. Most things will be, but there will be places that will go up, and you can also make money on things when they go down. So there's always a way to make money, even in the worst of times. So a bad situation could end up could be the thing that creates you great wealth, you know. So I'm gonna try to keep us focused on that. There's no reason to be afraid. We need to be clear-headed, and get educated and be sniper-like in our action. We got to get this money. I'm gonna sign out right now. Peace, fam. Later.